Some of the strongest performing banks in the country are structurally exposed. That statement feels counterintuitive because in banking, performance is the primary scorecard. Return on assets, return on equity, efficiency ratio, credit discipline, growth trajectory. We are trained correctly to believe that strong performance equals strength, and in many ways it does. Strong performance reflects discipline. It reflects sound underwriting. It reflects leadership capability and cultural alignment. But performance is not the same as position. Performance tells you how you've done. Position determines how you behave when something unexpected happens. And the market does not price outcomes alone. It prices durability. This is where the distinction begins to matter. I've watched institutions where the numbers looked nearly identical, and the outcomes were not. On paper, they looked the same. Under pressure, they behaved very differently. One was durable, the other was dependent. And dependency is discounted even when performance is strong. Over time, I've come to a simple conclusion. Premium value isn't just performance. It's performance multiplied by transferability. Performance builds strength. Transferability determines whether that strength survives transition. And transition doesn't only mean selling. It can mean a leadership change, a board shift, a regulatory challenge, an unsolicited inquiry, or simply the passage of time. Now here's where things become less comfortable. When performance begins to concentrate inside individuals, it doesn't feel risky. It feels efficient. If you're the CEO and most major decisions run through you, that likely happened for a reason. You were capable. You were decisive. The board relied on your judgment. If one lender carries a disproportionate share of relationships, that didn't happen by accident either. They earned that position. Concentration often begins as competence, but over time, competence can quietly become dependency. And dependency changes how outsiders evaluate durability. I've seen banks where everything ran smoothly because one person quietly held the threads together. Customers called them first. Directors deferred to them. Strategy required their interpretation. From the inside, it felt strong. From the outside, it looked concentrated. Buyers don't frame that emotionally. They frame it structurally. What happens if that individual steps back? And if the honest answer to that question is, we haven't fully institutionalized that yet, the evaluation shifts, not dramatically, quietly. That's the part most leaders don't see until later. There's something else that happens when performance is strong but structure is thin. No one announces it, but you feel it. You grow carefully. You hesitate slightly. You postpone certain upgrades, not because the bank is weak, but because you instinctively understand how much depends on a few people holding everything together. That's not failure. That's exposure that hasn't been examined yet. And exposure doesn't show up in earnings. It shows up in how confident you feel when conversations shift. I've watched banks that looked identical on paper behave very differently once real decisions had to be made. One moved calmly. The other hesitated. The difference wasn't performance. It was structural durability. Durability isn't about optimism. It's about whether the institution can withstand transition without scrambling. Leadership change, board change, unexpected opportunity, unexpected pressure. The market doesn't just price what you've done, it prices how stable the future looks without you in the center of it. That's why fragility is discounted long before anyone calls it fragile. Many banks quietly operate in what could be called high-performance dependence. strong earnings, solid credit, good culture. But beneath that strength is limited leadership depth, unclear succession, informal processes, undocumented governance alignment, critical relationships concentrated in a small circle. None of this disrupts performance today, but it influences how the future is valued. And valuation is not the only consequence. Structural dependency affects strategic confidence, board conversations, growth posture, and optionality. Because when durability is uncertain, subtle hesitation enters decision-making. You may not see it, but you feel it. Strong performance can mask these questions. In fact, strong performance often delays them. Because when results are good, discomfort is low. And when discomfort is low, examination is rare. But structural thinking is not triggered by comfort. It is triggered by foresight. The valuation equation is simple. Performance multiplied by transferability. If either variable compresses, premium compresses. If transferability is weak, performance is discounted. If transferability is strong, even moderate performance gains resilience. That's why you sometimes see average performing banks receive surprisingly strong outcomes. Because structure is durable, leadership is distributed, processes are embedded, customer relationships belong to the institution, governance is aligned. The future looks more stable, and stability commands confidence. Confidence commands premium. The important distinction is this: performance earns respect. Position demands control. They are not the same. Control is not granted at the moment of negotiation. It is accumulated through structural durability. And structural durability is built long before it's tested. This is not a warning. It is an invitation to clarity. Because dependency is not failure. It is simply concentration that has not yet been examined. And unmanaged concentration becomes expensive only when timing changes. Until then, it remains invisible. So here's the real question. If something changed tomorrow, a leadership shift, a serious offer, a sudden acceleration, would the bank keep moving the same way? Or would everyone look to a few people to hold it together? That's not criticism, it's structure. Strong performance is something to be proud of, but strong performance can sit on top of concentration. And concentration feels fine right up until timing changes. I'm not suggesting you plan for a transaction. I'm suggesting you understand what would happen if the environment changed, because eventually it will. And it's better to understand your position on a quiet Tuesday than in the middle of a conversation you didn't expect.